Okay, let's unpack this. We're diving into a really specific corner of global finance today, Canada's small public markets.
That's right. We've been looking at some analysis, some articles about the unexpected costs and maybe burdens for companies listed there. We're talking TSXV, CSE.
And our mission really for you today is to get into the source material and pull out two key things.
Yeah, first, what's the true cost, maybe the hidden cost of raising money on these Canadian venture exchanges?
And second, we want to give you a kind of financial reality check. We'll use a real-world example, a clean tech company called Chart Technologies Ltd.
Okay, but before we dive into, the nitty-gritty of private placements, maybe let's set the stage. Because the structure of Canada's public markets is, well, it's pretty surprising.
How so? What stands out?
Well, the sheer volume, for starters, if you compare us to the US, Canada has something like 5.75 times as many public companies per capita.
Wow, 5.75 times per person.
Per person, yeah.
Wow.
And globally, just looking at the raw numbers, Canada's third, right behind China and the US.
So Canada is set up to be this, like, global hub for listings.
It seems designed that way, but that huge quantity immediately makes you ask questions, right? About quality and maybe more importantly, about profitability.
Yeah, that quantity leads us straight there. What about the health of these companies? There are, what, over 2,250 of them on the venture exchanges?
That's the number, yeah. And the data, well, it paints a pretty clear picture.
Which is,
These exchanges are just overwhelmingly populated by very, very early stage startups. Think pre-revenue or maybe just starting development. They're not really self-sustaining growth companies yet.
okay, so lots of potential, maybe, but not established businesses.
Exactly. And here's the critical part. Something like 5%, maybe even less, of these listed companies are actually profitable.
Only 5%.
Or less. So they basically exist in this state of perpetual dependency on raising more capital.
Which means they constantly have to go back to the market for money. Not necessarily to expand because the business is booming, but sometimes just to, well, keep the lights on, keep development going.
Precisely. And this whole situation, this dependency, it actually fueled a big policy debate not long ago.
Oh, right. I remember reading about that. What was the core argument?
Market experts were basically saying that Canadian tax rules were, maybe unintentionally, discouraging successful private tech companies from going public.
How?
They pointed out that these private companies are called CCPCs, Canadian-controlled private corporations. They had access to much better tax incentives, like the big one, the SR&ED Tax Credit.
Okay, hold on. SR&ED, for listeners maybe not familiar, what is that exactly?
Right, SR&ED, it stands for Scientific Research and Experimental Development. Think of it as Canada's main tool to encourage R&D here at home. It gives companies refundable tax credits for things like wages, materials, stuff linked to innovation.
Got it. So private companies have got a better deal on that.
For years, yes. The argument was that private CCPCs could really leverage SR&ED to grow organically, but the moment they went public, poof, they lost access to the best, most refundable parts of that credit. It was a huge financial barrier.
I see. So the system kind of pushed companies to stay private longer if they wanted that R&D support.
That was the argument. Now, our sources do note that the federal government tackled this recently. The latest budget increased the R&D incentives and extended eligibility to public companies, too.
So some movement towards leveling the playing field there.
There was. But, and this is crucial, even with that tax rule change, the basic transactional cost of raising capital in the public markets, especially these venture markets, it remains incredibly high.
And that brings us right to the core of this deep dive, doesn't it? Quantifying that high cost of capital.
Exactly. Let's really break it down. We need to look at how a typical, say, $1 million private placement works. That's the main tool these companies use.
Okay, let's do it. We want you, the listener, to really follow the money here. See where that initial $1 million actually ends up.
All right, so you start with a headline number. $1 million gross raised. What comes off first? The explicit costs.
Like legal fees.
Yep. Legal fees for the offering documents, regulatory filings. That's easily $25,000, maybe up to $50,000 right off the top.
Okay, so that's gone. Then the brokers get paid, right? The ones who arrange the deal.
Absolutely. You've got broker cash fees. Often that's, say, 5% to 8% of the million. So $50K to $80K there.
And that's not all from the brokers, is it?
No. You usually also issue broker warrants. Plus, there might be other finder's fees, maybe another 5% to 10% combined value, sometimes more.
Explain broker warrants quickly. What are they?
Think of them as a sweetener for the broker. They get the right, but not the obligation, to buy company stock later at a fixed price. It doesn't cost the company cash today, but it represents future dilution, future cost. Still, it's part of the transaction cost.
Okay, so let's just tally up the explicit cash costs we've mentioned. Legal, say $30 UK average, plus broker cash fees, maybe $70. Are we around 100K, 125K lost already?
Yeah, a conservative estimate, ignoring the immediate value hit of warrants, you're probably looking at losing around $125,000. So your $1 million is now $875,000 net.
$875,000 net. That still sounds like a decent chunk of change for the company.
It does on the surface,
Yeah.
but this is where the less obvious costs, the sort of mandatory, non-negotiable expenses really start to bite.
Okay, let's maybe use an analogy to help picture this money disappearing.
Good idea. Imagine you got that $1 million loan, but it was for a home renovation. The $125K in bank fees and closing costs, those are like the explicit fees we just talked about.
Okay, makes sense.
But now, before you can even buy paint or hire a contractor, the lender, the bank, insists you spend a chunk of that loan money on mandatory advertising for their preferred neighborhood development project, using flyers they approve.
That sounds suspicious. Like, why would I do that? It sounds like you're talking about marketing fees the company has to pay.
That's exactly what it often is. You have to factor in what's essentially a mandatory market-making or marketing budget.
Mandatory.
In effect, yes, this includes maybe some pre-finance marketing, could be 10K to 50K, but the big one is the post-finance marketing spend. That can easily be $200,000, sometimes more.
200,000 just on marketing after the money is raised.
Yep. And our sources also mention this thing called a check swap for marketing. That could be another $100,000 layered in.
Whoa, okay. What on earth is a check swap for marketing?
It's a way to fund marketing without the company writing a direct check from the proceeds. Sometimes the company might issue shares directly to a marketing firm.
Okay.
More commonly, though, the broker who arranged the financing might bring in a specific investor for the placement, but only on the condition that the company agrees to allocate a big slice of the money raised to hire a particular marketing or IR firm. Often, surprise, surprise, a firm connected to the broker.
Ah, so it ensures the broker's network gets paid, whether the company ultimately succeeds or not.
It certainly looks that way. It locks in spending. So let's add up these, let's call them non-negotiable marketing costs. Let's be conservative again, say a $250,000 total budget for pre- and post-finance marketing, including any swap.
Okay, 250Ks or more.
That $875,000 net we had, it just dropped to about $625,000. That's what's actually left for the business itself.
So you go out saying you raised $1 million, but only $625,000, maybe even less, actually lands in the company's bank account for, building the product, paying engineers, running the actual business?
Exactly. And think about this. Just the basic annual cost of being a public company on these exchanges, listing fees, regulatory filings, extra accounting, legal, that runs about $200,000 a year, roughly.
Wow.
So that $1 million raise after all those costs effectively bought you maybe 3 years of just covering your public company overhead, not necessarily the growth capital you thought you were getting.
That efficiency is,
Ugh.
it's brutal.
Yeah.
But why? Why is this marketing spend mandatory? If the company needs the cash so badly, why can't they just say no thanks to the broker's suggested marketing firm and keep the $875K?
It really boils down to power dynamics and protecting the interests of the people who just put up the money, the broker's clients. Remember how this started?
The private placement.
Right. Those shares were sold at a discount to the market price, maybe 15%, maybe 25% below where the stock was trading.
Okay, so investors got a deal.
They got a deal, but they can't sell immediately. There's a mandatory 4-month hold period in Canada before they can sell those discounted shares on the open market.
Oh, it's a 4-month hold, right.
So the investors are sitting on cheap stock, but it's locked up. The broker's number one priority often is making sure their clients, the ones who funded this deal, can get out profitably when that 4-month clock runs out.
And the marketing budget is the key.
It's the mechanism. That marketing money gets spent strategically right around the time the shares become free trading. The goal is to generate buzz, news flow, buying volume in the open market.
To create demand.
Exactly. To create demand so the private placement participants, the broker's clients, maybe the broker themselves, if they took warrants, can sell their discounted shares into that artificially stimulated volume and lock in their profit. They might also exercise those broker warrants then, adding another layer of profit for them and more dilution for the company.
So let me get this straight. The company pays high fees up front. And it's effectively required to spend a huge chunk of the remaining cash to pump its own stock price, specifically timed so the initial investors can dump their shares.
That's pretty much the dynamic the source material describes. The company is essentially financing its own future sell-off pressure.
That seems like a huge danger.
It is. It's the core risk highlighted. A company might trade, say, $1.2 million worth of its stock if sold at a 20% discount, plus warrants, just to get maybe $600,000 in actual usable cash.
And the consequences.
Massive dilution for existing shareholders. And you're left with this stock overhang, a big chunk of shares just waiting to be sold, creating downward pressure. And you've already spent the marketing money that might have helped absorb it.
So what's the advice then from the source?
The key advice is pretty blunt. If at all possible, try to bypass the traditional broker channel for these small raises. Look for a single lead order, a strategic investor, someone interested in the long-term business, not just the 4-month flip. Quality over quantity.
Okay, that theoretical breakdown is, frankly, quite concerning. Let's make it more concrete now. Let's shift to part 3 and look at that real-world example. Char Technologies, Ltd., or CharTech.
Right, CharTech. They're positioned as a clean tech development company. Their focus is on decarbonizing for a circular economy.
How are they doing that?
They use a process called high-temperature pyrolysis, basically converting waste materials into renewable natural gas, RNG, hydrogen, and also a solid called biocarbon.
Okay, so on paper, they sound exactly like the kind of innovative, potentially world-changing company these venture exchanges are supposed to help fund and grow.
Absolutely. Ticks all the boxes. Clean tech, circular economy, high potential. But let's peel back the onion and look at the financial reality of their journey as a public company, using their financials up to September 30, 2023. This really shows the strain we've been talking about.
Okay, lay it on us. What's the headline number that jumps out?
It's the deficit. Since the company started, they've raised about $24.0 million in share capital from investors.
Okay, $24 million raised.
But their cumulative deficit, meaning their total accumulated net losses over the years, as of that date, was $24,142,830.
Wait, so the total losses are more than all the money they've ever raised?
Slightly more, yeah. Essentially, every single dollar investors put in through share offerings has been consumed by the company's losses to date.
That's staggering. It means they haven't reached sustainable operations, not even close.
Not yet. And the company's own auditors point this out very clearly. If you read the notes to the financial statements, there's a specific section labeled Material Uncertainty Related to Going Concern.
That sounds serious. What does it mean in plain English?
It's auditors speak for, we have serious doubts about whether this company can continue to operate for the next year. They state that the company's ability to recover its assets and keep existing depends entirely on either achieving profitable operations, which hasn't happened, or raising more alternative financing. It's a fundamental red flag about their viability.
Okay, so the $24 million raise didn't lead to profit. It just covered losses. Where did that money actually go? It can't all have gone into building pyrolysis machines, right?
No, and this is probably the most revealing part of the source's analysis. We can actually track significant chunks of spending related just to being a public company and dealing with the capital markets.
Like what?
Okay, since inception, CharTech has spent approximately $4.7 million on professional fees. That's lawyers, accountants, consultants.
$4.7 million.
The $4.2 million specifically on share issue costs and commissions, basically. The direct cost of raising that capital we talked about earlier.
Another $4.2 million.
And $4.7 million on share-based payments, stock options, and shares given to insiders, management, directors, and others as compensation.
Okay, let me add those up. 4.7 plus 4.2 plus 4.7, that's $13.6 million.
Exactly. $13.6 million spent just on those 3 categories. Professional fees, the cost of issuing shares, and share-based compensation.
$13.6 million on essentially overhead and capital raising friction.
Right. Now, hold that $13.6 million number in your head and compare it to the company's total revenue from all sources since its inception.
Which was?
Just $7.4 million.
Wow. So the cost of the public company apparatus and capital raising, $13.06, is almost double the entire revenue, $7.02 the company's ever generated.
Nearly double. That's the capital drain right there. The cost structure is overwhelming the actual business operations.
And there's another layer to this, isn't there, about where even that $7.4 million in revenue came from.
Yes, the source material points this out too. That total inception revenue of $7.4 million. It's actually less than the total amount of government incentives and grants the company has received over the same period.
How much was that?
Government support totaled $7.7 million.
So effectively, government grants have been a larger source of funds than actual customer sales.
That's what the numbers show up to that point. It starkly illustrates the friction we discussed. Here's a company pursuing genuinely important clean tech innovation, but the vehicle they chose, the public venture market, seems to be structured in a way that consumes a massive portion of investor capital before it can effectively be deployed into the core technology or business growth.
Which brings us back full circle to that question the source material keeps asking. In this kind of setup, who's really benefiting?
Yeah, and the source is pretty direct in its conclusion on this. It argues that the people who have done well, often without taking on much risk themselves, are the professionals and the advisors.
The auditors, the lawyers.
The auditors, the securities lawyers, management consultants, the market makers, the brokers. They collect their fees, their commissions, their retainers, often regardless of the company's long-term operational success. Their risk is minimal compared to the risk borne by the investors who actually put up the capital.
We should probably add some context here for SR&ED, though. They aren't just tinkering in a lab. They're pursuing huge capital-intensive projects, right? The kind needed for that decarbonizing for a circular economy mission.
Absolutely. We should be clear about the scale of their ambition. They have major projects underway or in development. Thorold, Ontario, that's biocoal and RNG, construction and operation phase. St. Felicien and Kirkland Lake in Quebec and Ontario are in development. There's a joint venture at Lake Nipigon, and they're building an HTP system down in San Luis Obispo, California.
These sound like massive undertakings.
They are, and costly. The source estimates that the projected capital cost for just two of those, the Thorold and California projects, is around $50 million combined.
$50 million compared to the $24 million they've raised so far, which we know is already gone.
Right. It highlights the immense capital challenge ahead for them and why the efficiency of capital raising is so critical. If half your money gets eaten up by the process, you need to raise twice as much.
So, if this public venture route is so costly and maybe inefficient for these kinds of early-stage tech companies, what's the alternative, according to the source? What's the policy takeaway?
The strong conclusion drawn in the source material is pretty clear for many, maybe most, early-stage Canadian tech companies, particularly those still validating their core business model. Maybe going public so early isn't the best path.
So what should they do instead?
Bootstrapping, focusing on organic growth first, really lean on those R&D tax incentives, especially now that they're improved for public companies too, but they're still very powerful for private CCPCs. Use the small business deduction, build the business more quietly perhaps until it's more robust.
Because rushing onto the public venture markets too soon
Often just guarantees that a huge slice of any capital raised gets siphoned off by all these transactional costs and overheads we've detailed. It can actually prevent the innovation from scaling efficiently because the money doesn't make it to the front lines.
Right. This has been a really, really insightful breakdown. Let's quickly recap the key points for you, the listener. We started by seeing that Canada's venture market is huge in terms of the number of companies, but structurally, very few are profitable, forcing them into constant capital raising.
Then we broke down the true cost of a typical $1 million raise, showing how explicit fees, broker warrants, and especially those mandatory marketing budgets can easily eat up $375,000 or more, leaving maybe $625,000 for the actual business.
And using Shader Tech as that real-world case study, we saw the impact. $13.6 million spent on overhead, professional fees, and share issuance costs, compared to only $7.4 million in total revenue since inception. A huge capital drain.
Yeah, and what this deep dive really seems to reveal is a system that, okay, yes, it's intended to help fund high-risk, innovative companies, but its current structure appears, maybe unintentionally, to shift a lot of the risk away from the advisors and onto the investors while allowing significant fee extraction along the way.
Which leaves us, and you, with a final pretty provocative thought to mull over as we wrap up this deep dive. When we think about funding crucial national innovation, especially in areas like clean tech, is the best approach simply to keep pouring in government money grants, tax incentives, to basically subsidize companies against this market friction? Or does the focus need to shift towards fundamentally reforming the structure of these public venture markets themselves to reduce that sort of near risk-free extraction of capital by the market professionals and intermediaries? Something to think about.